Hey, good morning, everybody. It's Hammer. Today is Monday, June 24th, 2024. I'm the originator for the Daily Mortgage Rate Update. Welcome back. It's Monday. Hope you are having. Remember, you can join me live each and every day, 9:30 a.m. Eastern Time each weekday as we broadcast on Facebook and YouTube, letting you know what's going on in the markets and with rates each and every day. Remember, if you're watching on the replay, don't forget to give me a hashtag replay in the comments. Let me know that you were here. Let Facebook know that you were here. If you're here live, say good morning, like Kyle Mazikas with the hashtag live. Good morning, Mr. Kyle Mazikas. Good morning, Mallory Fotiatis. Great to have all of you here. Deb Dickinson. Good morning, Harry Dennis. Megan Lindberg. Great to have you. Don't forget to smash that like button, tag an hello friend, share us in a group. If you're on YouTube, don't forget to click the thumbs up, subscribe, all that good stuff. And if you'd like to get a copy of our free email lock advice to your inbox each and every weekday morning, you can get that at www.ratelockadvice.com, www.ratelockadvice.com, or you can use this cool QR code on the screen. You can also sign up for our text alerts. They're $7 a month. If you'd like to check those out, you can find them at www.ratetextalerts.com. If you'd like to sign up for our text reminder that I'm going live each day, that's absolutely free. That's hmmr.io/reminder. My Hammer short code, hmmr.io/reminder. And last but not least, as we head into the second half of 2024, you need to make sure you are growing your business. We can help you do that at Originator Success. Find out how we help you get loans from Google and social media. Check us out at originatorssuccess.com. We help you generate reviews. We've got some great content that goes out. Be sure to go check it all out. Who else we got on this morning? We've got Brandy Brickler. Good morning, Brandy. So wonderful to see you. Kenny Rivard, great to see you, sir. Kelly Cargill, good morning. Michael Love, great to have you here as well. Angela Walters, good morning. Ron Siegel, great to see you, sir. Ron says today is National Pralines Day. Sometimes you feel you don't. Pralines. What are, I'm not real big on pralines. Don't know much about pralines. So, but I'm going to jump right in this morning. We're going to get into the good stuff. Let's get into what's going on with rates and pricing and all of that jazz. So taking a look here, we will go ahead and let's turn on the screen, take a look at the technicals. Mortgage-backed securities right now. It's funny. It shows, I've got the 10-year treasury yield. That's why. Let me go ahead and bounce this to mortgage bonds. Here we are. All right. So mortgage-backed securities, we're currently up 1 basis point to start the day. Make that a little bit smaller. There you go. So we're currently up 1 basis point to start the day, which is a little bit better than being down. We started the day down just a few basis points, about 5-6 basis points after overnight trading, and then it recovered this morning. So we're basically flat. Rate sheets should be about the same as what we saw last week on Friday, which really we haven't seen much of a change in rates all of last week. We started out 7.04, ended the week 7.01. Not even enough to really argue that we saw any real rate adjustments here. Just kind of the bottom line rates very much the same as we have been seeing. And why is this not my all right, well, it's not adjusting to the right size, so I will manually adjust it here. So hold on a minute. There we go. My quick snap isn't working. There you are. All right. So again, taking a look here, 10-year treasury yield 4.26. Now, where does that actually bring us? It's a little bit worse than Friday. 4.26 actually where we ended the day on Friday. 4.26 on Thursday. So 4.250, which is actually 4.26 right now. So we're really just flat. Bonds not worsening, not improving. Take a look as far as what we've got on the week this week for economic data. The big thing, I'm going to move my head out of the way for a minute. We'll look at the economic data. Hold on a second. Let me switch this to, here you go. All right, taking a look at economic data. Let me make this a little smaller. All right. So this week, today, we've just got a couple of Fed speeches. You got Waller and Daly, and it really doesn't matter. They're not going to have any effect on anything. On tomorrow, Tuesday, we've got Bowman speaking. We've got consumer confidence for June. You've got Case-Shiller and FHA pricing, home prices. This is just housing data. Two-year note auction. Fed Bowman speaking. I guess he speaks twice tomorrow. On Wednesday, We've got the 5-year auction. Otherwise, really not much going on at the beginning of the week. On Thursday, we're going to have the GDP data, the jobless claims. That's going to have a little bit of an effect. The GDP data, they're also looking at what the quarterly PCE comes in at. And then on Friday is the big day with the actual PCE data. So the PCE data is basically what everyone will be looking at. It's easier. I'll just the 5 things start the day kind of goes into it. So the dollar is steady. Treasuries are flat. Stock futures are fluctuating a little. The market awaits catalysts set to come later in the week. Sites are trained on the release of the Fed's favorite inflation gauge, which we all know to be the PCE, personal consumption expenditures. So that'll be what everybody will be looking at, and that'll come on Friday. So basically, where does that put us as far as locking or floating? I've been locking anything closing in the near term up through last week. Going to go ahead and switch that this morning since we're starting off on a good note. Basically, cautiously floating anything closing in the next couple of weeks. We want to see if this week helps us to improve a little bit. Looking at the technicals, we've got some resistance in place here that could get in the way. Let me see if I can. Nope, this is now won't let me adjust it. Let me just refresh the screen. So anyway, we've got some technicals that'll come into play. Mortgage-backed securities kind of hitting that 100.70-ish, 0.75 area there. Hold on a minute. Let me just resize this and get rid of that and then come back down. All right. Sorry, y'all. My snap tool's not working. I'll restart my computer later and it'll refresh. But in the meantime, let me just open this back up for you. All right. So we want to keep an eye on the technicals. We got 100.75-ish. A little bit of room to improve on the day before we kind of cap out. You can see it right here. Let me take a screenshot and show you where that line is real quick. Same thing on the 10-year treasury yield. We've seen that 4.26 come up a bunch of times. The lowest that we actually got down to was 4.22. I don't think that we're going to get much better than that unless we, see a really favorable response to that PCE data. Now, remember, we know the PCE data is expected to come in showing some of the best inflation numbers we've seen for the year. How much of a response we'll see to it, though, is the question. So, but right here, let me just go ahead and draw you a little line. This is kind of what we've got going on as far as like our our high point here. So there's a little bit of room right here. You could see just the gap between what the mortgage-backed security candlestick is at and the line that we can move up to. It's not likely that we break above this unless that PCE data is good on Friday. It kind of gives us a boost. We're not going to see rates really drop that much, though, until we get to next week. So next week, we've got, of course, July 4th, and then July 5th is labor data, BLS jobs data release dates. Let's just double check that is on the 5th. Schedule of releases, and that would be on... Yes. So it is on July 5th. Just double checking, even though I didn't think there'd be an issue. But so July 5th, that'll be the only thing going on. Traders are not going to be around for the holiday weekend, but they'll be looking at this, and we could see an exaggerated move to that. Now, if that shows some weakness in the labor market, it could be good for rates. And there's a lot of talk about that. When I read these articles, reading what's going on in Bloomberg and things like that, so for example, this article says, how long can... let me just make this a little smaller so it fits into there. Up. Okay. How long can high rates last? Bond markets say maybe forever. And basically, this talks about the idea of what is the Fed's neutral rate. So the neutral rate is right now the Fed funds rate is a 5.25 to 5.5, right? It's in a range 5.25 to 5.5. How far can they drop it before it reaches a level where it's not helping the economy to improve, but it's not hurting the economy? If they were to take the rate too low, then the economy would actually heat up and we would be improving the economy, and markets don't want that to happen. The Fed doesn't want that to happen because that would push up inflation again and cause problems. What they're looking for is what they call the neutral rate, where they say, okay, where do we bring that Fed funds rate down to where it kind of keeps everything level, where unemployment doesn't go up, but it doesn't go down. The job market remains strong. The economy remains strong. And this article is really about an argument that, we may be seeing that neutral rate higher than what the Fed thinks it is or where things are at. So, um, the significance being when the economy inevitably decelerates, there'll be fewer rate cuts. Interest rates over the next 10 years or so could be higher than they were over the last 10 years. And that's probably realistic because we did not have any kind of inflation before, but it's very unlikely that they need to drive the rates down that much to see things improve. So the idea of where this Fed funds neutral rate is, and markets believe that it's higher than what the Fed is. So if you look at the Fed's projections, the Fed says, we think we're going to get it down to, I believe, the twos. If we take a look here and we go to the dot plot for the Fed funds rate, in the longer run, you could see that they're looking at about 2.75 is the expectation for where would be kind of that neutral Fed funds rate. Markets say, hey, we think it's going to be higher than that. So, but that's kind of what everyone is waiting on to see. Here we go, though. U.S. bond markets meanwhile facing one key indicator flashing a bearish signal. Treasuries on the cusp of erasing their declines for the year, and traders are getting more confident on the possibility of rate cuts emerging from the Fed. However, the neutral rate theoretical level at which borrowing costs neither stimulate nor restrict growth is much higher than currently being projected by policymakers. So markets are kind of sitting back saying, hey, this is what we think is going to happen, where we think things are going to be. Markets still pricing in that the Fed will stay exactly where it's at for the July meeting in about 6 weeks. But at the September meeting, markets believe about 65% expectation that we'll see at least one rate cut. That grows in November to over 75%. And in December, markets pricing in, at least 2 rate cuts. Right here, you could see 2 rate cuts, 45%. And the idea that we could see 3 rate cuts, about 20%. More probability that markets believe we'd only see 1 rate cut than 3. So we'll see as this adjusts based on how, the data comes in. Next week's labor market data could be big. This week's PCE data will help with that. So anyway, we're in that spot where you want to go ahead, cautiously float everything. Not a lot of risk of seeing things get worse from here. They could creep a little bit, though. We want to keep an eye on it. We're only up a couple basis points on the day. So that is it, my friends. So I hope you are having a wonderful beginning to your week. This is nice to at least see rate sheets holding steady. Again, they're not really improving much. Anything locked last week, still in a good position. But we do now want to start paying attention to see what is this week going to bring, and could Friday help see at least a little bit better rates. So we'll cautiously float to start the day and see where we go from there. All right, my friends, I hope you are having a wonderful, wonderful week, and I'll see you tomorrow.